Hi, this is Patrick Donohoe, and thanks for tuning in to this week's episode. For most Americans, taxes are a consistent source of stress year after year. And, the typical financial planning world has successfully convinced the American public that the best no brainer tax strategy is to max out your 401k. Then, if you have kids, to put money into 529 plans. And then, if there's money left over, to contribute to a Roth IRA. And that's pretty much it. It's almost as if you don't do these things, there's something wrong with you. But in my experience and through the extensive study I have done on this subject, this tax strategy has not helped Americans, and in most cases has damaged a person's financial future. Now, it's not to say that tax strategy isn't important. I consider tax strategy as a vital component of a successful wealth strategy, which is why our approach here at Paradigm Life consists of both tax efficient financial products and strategic partnerships with tax professionals so that you can not only achieve the best short term results, but don't sacrifice the long term results, which is in most cases the reason why the 401k may not be the best approach. Now, today we're going to dive into a few of the powerful tax benefits of the Wealth Maximization Account, which is a dividend paying whole life policy designed for maximum cash value. Now that for those of you who are clients, your WMA is the foundational piece of your wealth strategy or a primary piece. Having a complete knowledge of its tax benefits is really important. And it's also, important to note the long-term tax benefits as well. So they can help you navigate not just right now, but your future path to financial independence. So let's go ahead and get started. Welcome to the Perpetual Wealth Strategy podcast. So permanent life insurance, it's been around for a really long time. It pre-existed the United States. And of course, the 1913 Income Tax Act, when the income tax, which was supposed to be temporary, but ended up being permanent, and rates have been increasing ever since. And I look at it as this foundational piece of a wealth strategy today, and it's not just because of the tax benefits, but the tax benefits definitely help. Now, what's interesting is, these the policies, dividends, interest, it pre-existed, the Income Tax Act. Now, not to say that it hasn't been impacted since, because it was in the 1980s. There was definitely some tax overhaul, and life insurance was included in it. It was actually kind of a last minute thing, but it hasn't been impacted since. And it's interesting that it has been on the table with many administrations, notably a couple times with the Obama administration, but it was also part of the 2017 potential, tax reform, which we just kind of went through over the last couple of years. It was on the table, but if you look at why it wasn't included, it's because number one, it is there's huge lobby associated with it, the financial services lobby, the insurance lobby, who was able to talk to Congress, talk to representatives, and educate them on the nature of insurance and how it replaces loss. Of course, we don't pay taxes if our car gets hit or demolished, and we get a car replacement. We're not paying taxes on that. It replaces something that already exists. And as far as cash value is concerned, being kind of this net present value of a future benefit, it totally makes sense. And so them being able to sensibly get into these lawmakers' offices because of their clout and influence really helps educate on the reasons behind why there are so many tax benefits with insurance. Now, not to say that that's going to continue to happen. The future is unknown, but looking at the past, there's a couple things that I would say provides me peace of mind and certainty, and should provide the same thing to you. Number one, it's only been changed once, and then the changes only affected contracts and policies going forward. Didn't affect the ones that were already in force, which is interesting to note. So if things happen in the future, because it's a contract, the contract, essentially the two parties that went into this contract, you being one of them, me being one of them, the insurance company being the other, they did so with a understanding of the environment of taxes. So that if taxes changed on existing contracts, there's definitely repercussions when it comes to contract law. So looking forward, I think the peace of mind is that if things do change and we already have policies that are part of our financial strategy or wealth strategy, that they won't be affected. So not a guarantee, but you look to the past, and it provides a much higher degree of certainty than the other types of financial products that are out there and their taxation. Now, if you look at, I would say the primary tax benefits. We're not going to get into everything. There's lots of different ways to use insurance in estate planning, in business strategy, business planning. I want to talk just about a few of the primary ones that affect everyone. And of course, if you have questions about anything that I'm talking about, feel free to reach out to the team. Go to the paradigmlife.net podcast page. It has contact information. It also has all the show notes here, as well as a few supporting documents I think are going to help you as well. But reach out to your wealth strategist as well. And if you're not a client, then go to the website, and there are a few places you can request more information or to talk to someone. Okay, so let's get into the primary ones. So the tax free growth of cash value. I think that's an interesting one to note. So let me first talk about the type of the normal the typical taxes that are out there. You have taxes on dividends, you have taxes on capital gains, short term and long term gains. You have taxes associated with income. But if you look at a policy has a guaranteed interest or a guaranteed growth associated with the cash value, as well as a dividend that's paid because it's a mutual company. There are no taxes on that growth. Okay, so the money is growing inside of a policy, it's getting a dividend, and we recommend having dividends continue to compound. Setting it up that way, you have tax free growth. But there is some things to note when it comes to the different ways you can withdraw or take money out of a policy. The first one is you can change the way in which a dividend is paid. Usually, we default to compounding within the policy, but you can actually request it to be paid in cash. Okay. You can also take a partial withdrawal or surrender of cash value. And then the third way, which I would consider the typical way that we teach and advocate, is to use a policy loan, which is a loan from the insurance company that is collateralized by the policy. So nothing leaves the policy. Money comes from the insurance company from other accounts that they have, other products and so forth. So those are the three primary ways. So the first way, when it comes to dividends, so both dividends and withdrawals, there is some things to note here that are really important. The withdrawal, the basis amount, which is the amount you've contributed over the course of time, that amount is tax free. So for instance, if you had let's say an older policy and you had $500,000 of cash value, and you've contributed $250,000 of premium or contributions, then when you start to take either the dividends or partial withdrawals, you can withdraw up to $250,000 without paying any tax. When you go to $250,001, that is when the $1 would be subject to income taxes. So that's how that works. So it's essentially first in, first out. That's the nature of that taxation. But the policy loan is not taxed, which is interesting because we will typically teach, if you are setting your policy up specifically for future income purposes, you can withdraw all of what you've put in. And then once you get to, in this case, $250,001, then switch the withdrawals to a loan because those loans are not subject to taxation. So that's usually the tax benefit associated with the growth of a policy as well as the withdrawal. So when you look at a 401k and how the tax benefits work there, and then you contrast that to a wealth maximization account. The 401k is uh, there's no tax on the contributions. You're putting money in, the contributions are not taxed, and then all the money that goes in, the subsequent growth, uh, the taxes are deferred. But then when you take money out in the future, okay, you are taking money out at what the income rates at that time will be. The income tax rates will be at that time, and that is subject to essentially the contributions as well as the interest and the gain. Now, contributing today we have a certainty associated with what tax rates are. We don't have an assurity of what they will be in the future. And if you look to the existing state of our country when it comes to it being fiscally challenged, taxes are most likely going to go up in the future. I would say they have to go up. So looking at contributing money to a 401k right now when tax rates are, seemingly low, and withdrawing that money in the future when tax rates are going to be higher, okay, it should be a no-brainer that that's not necessarily a recipe for success. And so I would say from an a worry and anxiety standpoint coming from uncertainty, it's betting that the government is not going to change the taxes in the future. Of course, with the policy, you are contributing. It's kind of the opposite. It's very similar to how a Roth IRA is taxed. So you are contributing to it with after tax dollars. Okay, so you pay your taxes, then you contribute. But you have an assurity, you have a degree of certainty right now that there is likely never to be any tax associated with the policy proceeds ever again. Now, it's not a guarantee, but you have a high degree of certainty there. Okay, so let me get into a few other things with relation to business uses of a policy as far as funding is concerned, and then I'll talk about the death benefit, the what we call the legacy benefit. So from a business standpoint, so there are many creative ways to use the tax code to benefit small business owners as well as those who may be executives with bigger corporations. Let me talk about the small business owner first. So with a small business owner, there are ways in which you can pay a key employee using a 162 strategy. 162 is a section of the tax code that has to do with executive bonus. And you could use that in order to have a deduction to the company and then pass on some of those taxes to the employee. There's ways in which you can structure it so it makes sense for the employee, but those proceeds can go into an insurance policy as opposed to a qualified plan. So we have done several of these for clients. Now, for a corporation, and maybe you are an executive with a corporation, or you are maybe one of the primary shareholders or owner of the corporation. When it comes to executive pay, I talked about this in the book I wrote, Heads I Win, Tails You Lose, where uh, you can essentially use a split dollar arrangement, and therefore the executive can receive compensation that subsequently pays for a policy premium, and there's very little tax associated with that. So it's a great way to retain uh, top talent and so forth. I'm not going to get into a lot of those details, like I said in the beginning. If you guys have questions, definitely reach out to either your wealth strategist or our team here. Okay, now let's talk about the death benefit or the legacy benefit. So these benefits also apply to term life insurance. So it's pretty much the only tax benefit of a term life insurance policy. But the proceeds of a policy, when something happens to someone you own the policy on, or maybe you're the beneficiary of a policy, they will not be taxed from an income tax standpoint on those proceeds. And I would also, it's worthy to note that the liquidity of insurance is unprecedented. If you look at estates that I've seen transferred from one generation to the next, having to liquidate securities, sell securities at different times depending on kind of where the economy is, as well as real estate assets or business assets, it takes a really long time. And looking at insurance, it's actually getting even better than this. But within a few weeks, you will be able to have a check, or there's a few ways in which you can take money when proceeds pay out. But you have that money within just a couple of weeks. So looking at how your financial situation will change over the course of time. Right now, it may be for growth purposes. In the future, there may be some purposes to use it as the primary legacy asset. And so in the book, I talk extensively about a few ways in which which you can do this. So check that out. But when you do pass away, there's no income tax associated with those proceeds. Now, looking at the estate tax, so this is where it could potentially trigger an estate tax. So life insurance proceeds, if it's owned by you, uh, even if it's the beneficiary is a revocable living family trust, the proceeds are still included in the estate calculation. And so the estate tax exemption right now is really high, some of the highest in history, I believe, but it's been much lower. So right now it's almost $12 million per person, and so there may not be as much worry for you. At the same time, uh, I see this potentially changing in the future. Right now, the government needs as much tax revenue as possible, and looking at the amount of money that's going to transfer from the baby boomer generation, I think they're licking their chops right now. So pay attention to that. There are ways in which you can have your insurance policy put into a irrevocable trust. There's a few different types of irrevocable trusts that are out there. Some very restrictive, some that are more modern, and you have more control over. But contact us, and we'll get through kind of what options may be appropriate for you. Now, looking at what we specialize in, of course, we've talked a lot about wealth strategy and kind of the scope of wealth strategy specific to estate planning as well as tax strategy. We have a strategic network, and it's a strategic network that we've developed over the course of time that consists of tax professionals as well as legal professionals, and so looking at what we're able to do and who we're able to refer you to, it may be appropriate to further enhance what the policy can do for you. So if that's the case, if you guys have any interest there, definitely contact your representative, your wealth strategist, or go ahead and contact us on our website. So as I mentioned, the website has quite a bit of information on there. There's a whole podcast page. There are some deliverables associated with this week's episode. So you're going to definitely want to bookmark that and check that out. Also, sign up for the email list because it will notify you when there are new episodes up. Okay, so that's it. Thanks for joining me, guys, and giving me your continued time and attention. It means a lot. I really enjoy doing these episodes because I believe that your ongoing financial education is important, and I'm just honored to have you here and have your support. So, as I mentioned, be sure to visit the Perpetual Wealth Strategy podcast page, which is on paradigmlife.net. All past episodes, all future episodes will be there. We have lots of other resources for you. So, join me next time as we get into one of the most often misunderstood benefits of the perpetual wealth strategy, specifically the wealth maximization account, which is the loan provision. We're going to dive deep into the options that you have both now and potentially in the future, which can positively impact your financial life. So we'll see you next time. Thank you for listening to the Perpetual Wealth Strategy podcast. Be sure to visit the show's official page at paradigmlife.net for appropriate disclaimers and terms of service. Guest opinions are their own. If you require specific investing, financial, legal, tax, or any other specialized advice, please consult an appropriate professional or a wealth strategist at Paradigm Life. We welcome and appreciate reviews of the show. Head on over to iTunes or Stitcher to leave your review today. And don't forget to subscribe to the show to get access to every new episode and its exclusive content. Thanks again for joining us, and we'll see you next time.